Owen, you joined us last week for the first segment on some tax tips. And last week we were talking about using your vehicle at tax time and doing some write-offs. What do you have in the agenda today?
I thought I'd talk a little bit about financial management as it relates to taxes.
Okay.
So right now, you're in the beginning of February.
Yeah.
Quickly getting close to Valentine's Day, as you mentioned.
Yeah, don't forget that.
And a lot of people are going to have a tax bill in a couple of months. And my question is, are you ready? And my experience when I meet clients for the first time is no.
No. Now, ready in what way? In
Ready
paying
to
your
pay that
accountant
bill.
or paying the bill itself?
Oh, both, of course. But
Yeah.
The
But-
bill's usually the big one,
I mean,
the tax bill.
and it's getting ready because at this point, it's already done, right? I mean, what you did for the year is done.
That's it.
But you got to... do most people not have an idea? Do they just automatically figure I'm getting a tax refund?
Yeah, you get a little bit of everything, really, to be honest with you. I had a guy a few months ago, hadn't filed in about 5 years, and he said, it doesn't matter. It's okay. It's okay. I get money back. I always get money back. I always get money back. And he was actually an owner in a company, and he wasn't getting money back.
No. Now, was it because of the business portion of it or the personal side?
No, unfortunately, his accountant didn't take enough tax off for him as the employee portion of his income.
Ah.
And so
That happens a lot, doesn't it?
it happens every so often. Yeah, for sure.
I know when I was working at a Toronto radio station, I took some time and I thought, okay, I'm going to look at the percentage they're taking off. And I asked them to take off more and they said, why? And I said, because I don't want to pay it at the end of the year. And they said, well, I know, but then it's your money to use and make money. I said, yeah, in philosophy, yes. In practice, no, because I'll tell you the truth. I probably won't pay enough attention to it. And at the end of the year, I'm going to get drilled and I'd rather not get drilled.
And that's what happens to a lot of people too. It's forced savings, basically, right? For
Yeah.
a lot of people. And I mean, if you're under a couple of $1,000s one way or the other, it's probably not going to make a big difference, especially if they have it of yours and then you get it back. That's always nice. Everybody
Right.
likes a refund in May. So,
But is it, if I'm looking at it, and in that case, I kind of realized that it was a low percentage they're taking off. For the average person taking a look at their pay, is there a percentage that they should be looking at to feel comfortable once they get to tax time? Like,
no,
it's
a moving
it varies.
target. Yeah. I mean, if you make 40,000 versus you make 80,000 versus you make 150,000, I mean, the tax rates, they go up incrementally, unfortunately,
Right.
to the point where you get to 200 and you're paying over 50%. So
Is there a magic point where, is it $40,000 and then from there on, as you mentioned, it goes up incrementally that you really want to pay attention to how much you're taking off?
no, you should always pay attention. You should always have a rough idea of where you're going to stand at the end of the year. That's what I do with my clients. And it's tax planning. Again, as an employee, most of the time you're going to be okay because there's just standard rates charts, right? So
Right.
if you make 40, you're going to take off this much tax, right? You don't run into too many problems unless, if you get paid by the week, let's say, or bi-weekly, and you normally make, $2,000 every 2 weeks. And then for some reason over a few weeks or a couple of months, you don't. Maybe your pay gets cut in half for some reason, or you're not working for some reason. And then you start up again, you may come up short at the end of the year because of that, because you're going to be taxed much lower for that period of time. Even though you will make less money, the top end will still be the same tax rate. It'll be the highest tax rate for your income. So
What happens if you are paying expenses? And I know you mentioned that magic form, the T2200 last week.
That's right.
Important to get that, obviously. But if they're paying you back in expenses, so you expend something, you get money, is that included in the tax? It shouldn't be included in the taxable portion, right?
that's
That you're
correct. The expense reimbursement is not taxable.
Right. So it should be a separate line.
It shouldn't be a line at all.
Okay. But at tax time then,
At tax time, the T2200 is where they will outline any expense reimbursement for perhaps kilometers or paying your cell bill or taking clients out to lunch or whatever the case may be. The way the T2200 is set up is it allows the employer to identify what expenses you were and weren't responsible for on your own in order to work for them. and what expenses were and were not reimbursed to you as a result.
For example, say you're running the office and you're buying the toner and you're paying for it on your own credit card, and then you expense the company back, and then they give you the money back. How does that work? Does it actually show up as a line item on the T2200?
Some companies do, some companies don't. But yes, it can. Yes, they can say, the employee was responsible for providing office supplies. Here's the total amount that was reimbursed to the client. But again, it's not taxable. It's not part of your T4. It's not part of anything on your taxes.
Right. Okay. But I think if the bottom line in all of this is pay attention as well to the information you're getting from your company. Every week or every 2 weeks, whenever you're getting paid, take a look and see what those items are there.
Absolutely. You can even look this chart up. I mean, you can Google. I mean, Google is the world now, right? So everybody can do it. You can just Google, say, how much tax am I supposed to make if I make 40 grand, right? And you Google it and it'll tell you, right? And it'll take you to the charts. It'll take you to everything. You can figure it out. And there's CPP and UI and, other deductions potentially at work.
How important are pay stubs?
Pay stubs? Well, I know people that have had some big mistakes. I know people that have had employers that didn't submit the T4. They took all the deductions this is just as an employee, right? So again, you make $1,000 a week and you have UI and you have CPP and federal tax, Ontario tax, it all gets taken off and you end up with your $637, right? So I've had several clients that have not received a T4 at the end of the year, and it turns out that the employer did not submit the T4 to CRA and therefore kept all the money.
Wow. Okay. So if I'm looking at deadlines, and I know you say file every year, no matter what, file every year. You need your T4 to do that. What kind of deadline are you looking at to make sure that, hey guys, I need my T4, and make sure you have it in hand?
Well, the companies have a legal obligation to supply your T4, T4A, T4, T5, whatever T slips that you get has to be in your hands by the end of February. Most employers send them out at the end of February, so it's usually the first week of March, but that is a legal obligation.
But it is important to file and make sure that you have your information ready and ready to send off to Ottawa.
Absolutely, absolutely. One of the things too, in terms of cash flow management, for businesses, is I really recommend, on a business side of it, your questions so far have been about employees, really, right?
Right.
So you get a pay slip and you get a T4, and you're counting on your employer to do the right thing in terms of tax deductions. But when you become self-employed, a sole proprietorship, or a corporation, then the onus is completely on you. There are no taxes deducted on your behalf. And so what I tell all my clients is put 25% away in a separate bank account every time you get some income. Every time you go to deposit something in the bank from a client, put 25% of it into a separate account. And that's going to cover your HST. It'll cover some of your taxes. An absolute worst case scenario is you don't owe any tax at the end of the year, and now you have some money sitting in the bank.
Right. As long as it's not too much, because then you get taxed on it.
Yeah.
I learned that one when I sold a house.
Yeah.
Oops, forgot. That's income, isn't it? And it does include income. Anything else to wrap things up here? And again, I did approach it from the employee perspective, but in many ways also that, that's the employer. In other words, don't forget there are a lot of small businesses, and you got to make sure that you're on top of that as well at tax time.
Absolutely. I do payroll for companies all the time, and it's important as an employer to make sure you meet all the deadlines. There's lots of deadlines, personal tax, sole proprietor, corporations, they all have different deadlines. So make sure you know them. If you don't, Google them out accountant and give me a call, and I'm happy to help you out with that. One last thing I'd like to mention is HST. So HST, people get excited when they think that they don't have to do something with tax, right? So we all can't stand CRA. We all can't stand taxes, except for me, because it keeps me employed. But everybody else, if someone says to you, you don't have to pay HST or you don't have to track HST, it's like this huge excitement, almost ready to go out and have a drink. The truth of the matter, that's not always your best option. If you have a lot of expenses associated with your business, even though you don't make $30,000 in income revenue, then you could be missing out on some cash flow. You could be missing out on income back in your pocket because you're not able to claim your HST on all your expenses. So if for some reason, if you say you make $25,000 in revenue pretty regularly, but you have, $15,000 in in expenses, all the HST on those expenses, if you didn't apply for HST, didn't register, and you don't do a return every year, all the HST from those expenses is lost, completely lost. If you were registered, you would actually get that money back.
Wow. So it doesn't sounds counterproductive, but it's actually productive.
It could be. It could be.
Could be.
It depends.
The important words.
Yes.
Could be. And the way to find out is to get a hold of you. Once again, someone wants to get a hold of you. How do they do it?
You can Google the Mad Accountant. You can call me 647-221-6936. And I find people just remember the Mad Accountant, so it's easier to Google it.
And you'll be back in again next Thursday with more tax tips.
I will. Thanks very much, Dan.
That's Valentine's Day, by the way.
Yes, I know.
I don't want any Valentine's.
That's okay. It'll give me an opportunity to get up early and actually put a card on her pillow or something.
See, there you go. It does pay off, and it does pay off to talk to the Mad Accountant. Thanks, Owen.
Thank you.